We can either directly write them off, or we can follow what's called the allowance method. GAAP likes one, and GAAP doesn't like another one. Undesirable. Really struggling here. We got to fix this. Generally accepted accounting principles are those kind of authoritative body that governs the ethics of accounting does not like the direct write-off method, simply because they want us to keep trying. Allowance method is more GAAP approved. In fact, GAAP requires that you really try to allow for ARs to become collected. Let's talk about some more specifics of each. With the direct write-off, so I've got these balloons. They're floating around. I'm mad at one of them because 30 days, 2 months, 3 months, 9, that's 90 plus days that they haven't paid their bill. I'm done with them. I just want to write them off and be done with them and just take the loss. What happens is there's no matching. The revenues and expenses are not matched appropriately. The receivable is not stated as cash realizable value. So, I mean, this is a form of cash. We're going to get cash eventually, but when I write it off, it's not considered cash anymore. And it really isn't acceptable for financial reporting. Allowance method, though, if we're not going to just throw a dart at one of these balloons, the allowance method is better matching. It will track revenues and expenses a little bit better. It allows for cash to hopefully be recovered. And GAAP is really in favor of this one versus just throwing a dart at one of our AR balloons and it's gone. Take some time to get those tables updated and we'll talk more about them. The book provides this illustration, taking a look at direct write-off versus allowance. And here is an awesome visual that really kind of makes you understand the whole matching is just at a huge disjoint here. So in year 2012, it looked like our net income was skyrocketing. We're running around selling, adding things on account. These sales, of course, to ARs made it look like 2014 was a great year. And after a year goes by and these ARs just refuse to pay their bill, again, 30 days, 60 days, 90 days, all out into a whole year, then all of a sudden all these customers right here default on their loans. They don't pay them. Should I pop them for us? I don't know if it's going to be loud or not. Boom, gone, done. Like I'm done with this balloon. A year's gone on, I'm done. Well, what happens then is we don't get our money from this thing anymore. It's done. And so then, although net income looked amazing that year, it really didn't pay out. Customers default on loans, it becomes a bad debt expense, and AR plummets. And so that's why GAAP doesn't like direct write-off. They think we should keep trying. The allowance method allows us to run around with these ARs. I switched up colors here. Still selling like crazy. We still see a huge increase in net income. We're selling like crazy and letting them charge. We'll even blow up another one. But the next year, instead of plummeting, which we're not going to do, we're going to let it just do this instead. You know, I've got these 3 ARs now. I sold a lot. 2014 net income went up. But instead of throwing a dart to this balloon, we're just going to just let a little bit of air out. I'm kind of mad at it. I'm allowing this one to still stay afloat. But instead of just throwing the dart and saying, I'm done with you, you know, they can come around and we can always blow it up a little bit more. So do you see the difference? It affects net income really drastically. 1 year's really great, 1 year's not. 1 year's really great, but instead of completely wiping out a balloon, maybe we're going to work hard at getting that balloon to actually pay its bill. And get rid of it, but it's still a balloon. It still is a customer that we can foster a relationship with. Okay? Let's keep going. How do these things look on the balance sheet then? Well, you have this in your notes, I assume, correct? Good. We have an asset, $500 balloon. I mean, literally envision $500 stuffed into this balloon that we can't get at until they pay it, or we throw a dart at it and say, well, that's 500's gone, or we just let out a little bit of its air. We've got this $500 worth of assets. Well, we have a contra asset account that's called the allowance for doubtful. Because let's be honest, we live in a world where not everyone pays their bill. I'd say all businesses experience this. And what this is saying is we probably are not going to get $500 out of our AR balloons. Someone is estimating that $25 out of it, we won't see. Okay, this has a normal debit balance where the plus is. Contra accounts are always going to act opposite of its partner account. So that's where we see a normal balance. So if we had to combine these two, I'd put this $25 here, and really we're only going to see $475 worth come back to us. Something is telling us that we're probably not going to see $25 out of the 500 that's owed. And that turns into just an icky business expense, the expense of doing business with ARs. Could we just wipe out ARs completely and say, we are not going to let people charge? Do you think we're going to turn away some customers though? We're going to do everything we can to get them to pay. We're going to offer them 2, 10, and 30 discounts. Okay? We're going to let them return merchandise that they don't like or went bad. We're going to call them. We're going to write them letters. We're going to have good, trusting relationships with them. But at the end of the day, even when we do all of those amazing things, we still will have bad expenses that occur. Again, what does this look like on the balance sheet? This is exactly what we just did, T account format. Do I have this in your notes? Yes, no, maybe? I don't know. Is it back a ways? I'm sorry, I didn't look at all of them. You can always write it in if you want to as well. Or it's in the book. So from a balance sheet perspective, you'll notice current assets are, you know, what's happening within 1 year. Cash, we're sitting there with $330. Maybe that means 330 million. I don't know what that stands for. We take AR less that contra account of allowance for doubtful, and we're really sitting there at that 475, which we just visually drew with our T accounts. Where did the 25 come from? someone's estimating that historically that's what, there's some kind of ratio there that an X amount of percentage won't be recovered. Or we could combine it all on one line. I'm going to show you this. I know you guys are still writing. I could combine it all on one line that way as well. I think this way looks a little bit more like, okay, I get it. This is definitely a contra account instead of shoving it all into one line. How do we journalize all this? I just really want you to envision the accountant running around with a handful of balloons. And that hand is on those balloons tight. Because that is a huge wild card in all of this valuation of our assets. Throwing darts versus just letting out a little bit of air. When you dart that balloon, just like what happened up here, it's gone. I can't put air back into this. Versus when I let just a little bit of air out, I can blow the balloon back up and recover that relationship really with that customer. So here are the journal entries. This is a direct write-off. So this is the dart to the balloon. Assume that Wharton Company writes off M.E. Duran's $200 balance as uncollectible. Are we going to get the money from that one? We're sick of them. GAAP says we should just deflate the balloon, but we're not going that route. We're just going to deflate or we're going to throw a dart. So what does it look like? Is AR going to go up or down in this case? If we throw a dart, is this AR going to be up or down? Down. So that's our credit, but we have to offset that with an expense called bad debt expense. It's just like turning the lights on. Utility expense. It's just like paying for stamps, postage expense. It's just like paying for an ad in the newspaper, advertising expense. It's just this leaves a very sour taste in the mouth of the business owner, doesn't it? Bad debt expense? You mean I have to have an expense for the people that don't pay their bill? Yeah. The AR is gone. AR looks like this. We know it's an asset. Here's the plus. So it was sitting there with a $200 balance, and we are going to throw a dart at that balloon. We're going to make it be zero, and we're just going to say, we're done with you. We're done. And we are going to eat that as a business expense, just like when we flip the lights on and we pay for an ad in the newspaper. This one, again, just leaves kind of an icky feeling in your mouth or in your gut. But that, it's easy. It's easy. It's just dart, done. How about the uncollectibles? Recording estimates. Let's take a peek at this one. Hampson Furniture has credit sales of $1.2 million in 2014. Holy cow, that's a lot of couches. $1.2 million, and notice what it said. Credit sales, people not paying with cash. Do you think that's true in the furniture industry? Yeah. Of which 200,000 remains uncollected at the end of the year. Okay. Let's make a quick T account. So this furniture store has $1,200,000 of balloons floating around. Like, you can visualize that. What a crazy thing. What was the remaining balance at the end of the year? Reread. 200,000. Well, you know what? They must have one heck of a AR department, because $1 million was actually paid. The balances were paid. That's pretty impressive. Would you agree? So at the end of the year, we've got $200,000 of balloons just still floating around, but we used to have 1.2 million. So this is a good thing, sort of. The credit manager, so this is a pretty big deal, this position, estimates that 12,000 of those sales we're not going to get. Okay, they're saying out of what remains, started at 1.2 million, paid off $1 million, or they paid us. Out of that $200,000, 12,000 of it we're not going to get. What do you mean that's a lot of money? I'm going to start calling these people. Yeah, we probably have. We've probably wrote letters. Do you think we've even knocked at their door and tried to get our couch back? Maybe. Okay. So what does the journal entry look like? Bad debt expense, 12 grand. Just like flipping on the lights, part of doing business. Yuck. It's a big expense. Notice what this one's called. We are not writing off. We are not darting that balloon. We're going the more GAAP suggested way. And GAAP is saying, yeah, we've got this $200,000. I'm sure the people listening on my YouTube channel here are going to appreciate me blowing up a balloon in my microphone here. $200,000 is this what this represents. We're going to let out a little bit of air. $12,000. But notice I didn't pop it. Like, could I blow that back up and eventually recover the money? Yes. Okay. So it's called the allowance for doubtful accounts instead. And I always like to rename this hopeful. The book doesn't call it that, but really the allowance for doubtful accounts, we're doubtful we're going to get it back, but let's show it the glass is half full. Let's be hopeful that we really can get that $12,000 back. Do you see the difference? Back here, wiped out. AR is gone. We still have a bad debt expense. This time, AR is nowhere in there. We're actually hopeful that we can recover this 12 grand at some point. What does this look like on a balance sheet? It's what we just made on here. It's this. But we're saying, okay, at the end, we've got this $200,000 balance minus what the credit manager thinks we're not going to get back. So its real valuation is $188,000. Now that AR could surprise us and actually show up with the money, but we didn't dart the balloon. We just deflated it a little bit. Notice what this statement says, though, and this might be something you'd want to add to your notes in reference to this $188,000. The amount of $188,000 represents the expected cash I don't like that word. Cash realizable. Seems like a weird word. Value. So if we had to put a dollar amount on our AR today, we would go with that because the credit manager thinks 12 grand of that we're not going to see. So if we had to put a dollar amount or a cash realizable value on it, it would be the 188. Down from 1.2 million, we've got a pretty good system. I want to pause and see what questions you have. What are you wondering? Yes. That's a good question. We saw it, what, $200 versus $100 or 12. Yeah, $12,000. You know what, Taylor? I don't know how to answer that question. We could look back in the book a little bit. Likely because it's one specific AR we're starting. This was like probably a bunch of ARs. So of course, when you add up several ARs balances, it'd be larger. So that's just my shoot from the hip answer. When you're writing off a customer, they would likely have a smaller balance. This last version that what we did represents our big stack of balloons. Good question though. What do we have going on in this one? The Vice President of Finance. Whoa, a bigwig. Back to the same furniture company. On March 1st, authorizes a write-off of $500 owed by just R.A. Ware. So this has a creepy connection to the question that Taylor just asked. So let me backtrack. Back here it's saying, okay, we started with the 1.2 million in sales. We've whittled it down to 200. A credit manager says we're probably not going to see 12,000 of it, and that's on December 31st. A couple months later, the VP of Finance is saying, R.A. Ware, I've tried. We can't get the money. So does this answer your question a little bit further, Taylor, that this is obviously a smaller amount than 12,000? They're saying this one specific, you know, if I had to turn this into a balloon, this one specific R.A. Ware is getting a dart. We've tried. 3 more months have gone by and this person has not paid. Okay, so what's our debit in this case? Bad debt expense. Whoa, excuse me, I did that wrong. Oh, okay. This 500 used to be coupled. This 500 used to be part of this bunch of balloons. Okay, so you know we've got this one, we've got this one, we've got this one. They all equaled 12,000, and one of them happened to be that R.A. Ware for 500 bucks. So instead of saying, I would have pegged it as an expense, but no, that makes sense now. Allowance for doubtful accounts actually is going to go down. We let more air out of our balloon because remember, this is a contra asset. This normally has a credit balance. So by debiting it means it's actually going down, and this AR is also going down. So it's like we're darting the deflated balloon, or one of them. Yes. Yes. Isn't that crazy? Sydney is wondering, you mean to tell me that if they get a direct write-off, they get by without paying? Yes, they do. Because think about, okay, we could sick a lawyer on them, like what Ira asked like last week, but is that going to cost us money? Yeah. So sometimes, you know, and very similar to like when someone files bankruptcy. They don't have to pay their bills. Someone else does it. And it comes down to, we've probably spent lots of man hours calling, writing to these people. So time has been expenses already. But yeah, they literally get by scot-free. Now, do you think we're ever going to allow them to charge anymore to us? And do you think we're going to tell our friends? Do you think we're going to tell our counterpart businesses, like kind of like a bad check? People will all of a sudden start to realize, don't take checks from these people. Don't let these people do ARs. So do you see why it's the allowance for doubtful is actually being decreased? because remember back here, these were our allowance for doubtful balloons, and we let a little bit of air out of that 12,000, like we're probably not going to get it, but now we actually darted one of our deflated balloons. So that's why you see AR go down, or allowance for doubtful, and then AR go down as well. I like this. I don't know if this is in your notes, but if it's not, please add it. This contra asset was originally valued at 12,000, and all of a sudden, one of those deflated balloons got a dart. We're done with RA Wares, who was part of that $12,000 deflated balloon group. So within allowance for doubtful, we're darting one of the accounts and writing them off. We still have a lot of deflated balloons floating out there. Let's hope we'll get the money from them. Of course, RA Wares is going to make our life even more miserable, but yet in a good way. Let's take a look at what happened on July 1st. So keep in mind that $12,000 you're probably not going to get happened on December 31st. Then we did a write-off on, I think, was it March 1st, somewhere in there, of RA Wares. Look what happened on July 1 now. On July 1, RA Wares comes knocking on our doorstep, down on his hands and knees, and actually says, I want to pay my bill. I want to reconcile our bad customer relationship with you. Now you're kind of annoyed because we deflated all these balloons and we said, out of this 200,000, we're probably not going to see 12,000 of it. We actually did a write-off of this RA Wares, and now 6 months later total, he's like knocking on the door, please, 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 can I pay my bill? Why are we kind of annoyed with this? Couldn't he have done that earlier? Or we've been calling and writing, and we got our VP of Finance involved and actually just said we wrote you off, and we just kind of were done with you. But what's obviously the good side of this? We're getting our money. So you see AR go up. Now hold the show. When a previously written off person shows up to pay, we actually have to reopen the account. Can't we just take the cash and kick him to the curb? You can't. You actually have to reopen the account. So we're going to act like he's charging. And then the allowance for doubtful goes back to where it was. Because this is not a sale. He had the sale way last year. This is not a sale. Allowance for doubtful has to go back up. Okay, now stop for just a minute. I'm going to backtrack. Right here, what just happened, and maybe there's going to be a T account that shows it. We had the $12,000 balance. We kicked RA Wares to the curb. We're done with him. So now basically we're going to put the $5,000 or $500 back to where it was. Okay, so we reopened the account. We went back to saying $500 is now really hopeful because he's standing here with a pile of money. So in the second transaction, he's actually going to pay the bill. So it's like a wham bam. AR has to go up, and we're not letting this AR leave because he has caused us 6 months worth, maybe even more, of heartache and headache. We're not going to let him leave until the cash is in our hands and we are truly done with you. Do you think we're going to keep doing business with this person? No, probably not. What's that? Yeah, but then all of a sudden, like, his bad track record caught up with him, or maybe his conscience caught up with him. You know, like what the Sydney said, you mean he gets by without paying this? So maybe collection agencies or legal teams got a hold of him and said, you better go pay your bill. But it's really annoying. This is the annoying part right here. We have to actually reopen his account, but we're not letting him leave until he pays us. And just remember, and I think out of anything, this is the tricky part, this one. Like normally you're used to when an AR goes up, it's typically a sales revenue that goes up as well as the credit. But remember, the sale happened a long, long time ago. We just dumped that 500 back into being the allowance for doubtful, but all of a sudden it's very, very hopeful because I see him in tears on his hands and knees with $500 in his hand. Let's keep going. We've got a new company now. Assume that Gonzalez Company elects to use the percentage of sales basis. So here's what this means. They're not going to take a look at our ARs. They're going to take a look at how many sales we made, and they're just going to slap a percentage on it. Like, okay, if you have this amount in sales, we're saying 1% of it you're not going to see. It concludes, so whoever it, again, that's probably some finance manager or credit manager or VP of finance, they're going to take a look at over time how many sales we haven't recovered, and they're just going to give us a number. 1% of those net credit sales, so net meaning after all the returns and all the dust has settled, the net sales, 1% of it, we're not going to see. Will become uncollectible. If net credit sales for 2014 was $80,000, how are we going to adjust? So if we had net sales, again, after all the dust has settled with their returns and paying for freight and all that business, what is the adjusting entry here? You're basically going to take 800,000 times 1%. And you will see bad debt expense at 8,000. Where did we deflate the balloon? AR doesn't go down when we are, nowhere did it say we wrote off 1,000. We're just saying, nowhere did I see write off. So it's not a dart, it's just a deflated balloon. So when we deflate a balloon and we're hopeful that we're going to get our money, what's our credit? What's the account called? Allowance for doubtful accounts. And remember, I'm hopeful that we're going to get that money. The 8,000, they show you the easy math there. It's the 800,000 of net sales. And some finance guy said, well, 1% of that you won't see. What's going to make allowance for doubtful? Because this is a credit. Remember, it's a contra asset, so it acts opposite of an asset. What would make that go down or be a debit? When we dart it, write it off. What would make it go up again? When that annoying write-off is down on their hands and knees begging to pay us. Then we got to bring it back to a credit first before we can say, pay your money and get out of here. Do you see what a challenge AR departments have? It's not just making sure we get bills, money in. It's tracking all these bad people, the bad guys. Did I put this chart in your notes? Yeah, you can just take a peek at it. It's just like taking a look at all our AR customers and what they owe and stuff that's still not due yet. Okay, then here's your 30, 60, 90, and over 90 days and tracking as it's not paid. This is basically an Excel sheet that, say, an AR person would watch. And then the estimate, the longer the time, the higher the estimate is that we won't see our money. And this is just a historical look. They can base these percentages off of history and the economy and all sorts of different stuff. Okay, so what do you do if you've tried and you've tried and you've tried and a year's gone by and you're sick of them? You don't want to write them off because we know that's truly an expense that we won't see, and it's kind of a whole flubub of accounting mess to get them to reopen the account, to turn around and pay the bill. What do you do if you've tried and tried and tried to recover an AR? You can sell them. You can sell the right to getting paid to someone else. Big sharks out there who are willing to take on the risk of someone else's misfortunes, basically. You can dispose of them. And companies actually sell, and I'd add the word bad receivables for two major reasons. Receivables may be the only reasonable source of cash. Like they rely on those receivables to pay their bills. And if they don't, we don't see cash. Well, we need cash. And so if these receivables aren't paying their bill and we need the money, we're going to sell them some way, shape, or form. This whole process takes an obscene amount of time. And time in the business world means dollars. We're paying someone to call and write. We're paying someone to sit there and reopen accounts just to close accounts again. So they sell them because they need the money, or they sell them because it's time consuming and we're sick of it, how much it costs. Those are the two big reasons. And selling an AR is called a factor. We sell our ARs to factors. There's lots of different factors. It's kind of a weird word for what it is. It's basically selling it to some shark who's willing to take on a ton of risk. Who are these factors? Finance companies or banks who maybe have the infrastructure, resources, or that risk-taking attitude to take on someone else's bad debt. Basically what happens, so if I'm running around, these AR balloons are all over the place and I can't get them to pay, I don't want to write them off. I've tried as the uncollectible bit. They, meaning these factors, these banks or these risk takers, buy the receivable or buy my AR balloon, and then they collect the payments directly from the customers. It's basically taking the risk off of our plate and selling it to someone else. Typically charges a commission to the company that's selling the receivables, and there's a fee involved. They're not going to just do this for nothing. We're going to have to pay for it, plus the AR will probably see an increase in their balance. I mean, that only makes sense, right? Some crazy shark who's taking on this risk, they're going to charge us, and they're probably going to tack on a fee to the service, as a service charge to the AR. Do you see this as a possible solution that would make sense? We can't get our money, so we're going to try to recover as much as we can. We might have to pay a fee, but it's better than a huge bad debt expense. So here's what it looks like. Assume the Hendredon furniture. Boy, the furniture business is really getting socked here. Assume this furniture, assume the I can't even say that, factors $600,000 of receivables to federal factors. So basically this furniture company is selling $600 of bad ARs to this, I'm going to just put shark there, the risk shark. The shark, or federal factors, assesses a service charge of 2% of the amount of the receivables sold. The journal entry to record the sale is as follows. So here is what the AR, and they're going to charge 2%. So on this $600,000 of balloons that we can't recover, we're going to actually pay 12 grand to get rid of it. Is that worth it? It must be, because we're doing it. We are going to receive this much in cash. Basically, the $600,000 balance minus the fee that this federal factors is going to charge us to take on this new risk. We see a service charge expense. Hang with me for just a minute. But we see AR go down. No longer do we have to deal with that $600,000 expense or AR because we sold it off, even if we had to pay 12 grand to do it. Not bad. I wonder if that's the last thing I wanted to do. No, we're going to do a couple more tomorrow, but that's okay. And then we'll get into the